Hi guys, thanks for tuning in to another episode of Nugget News. Well, in this special presentation, I want to give you a guide to investing in precious metals. It's a question that we get asked a lot, and there's a range of precious metals out there, but today I'm going to focus on gold and silver, the two that have traditionally been viewed as monetary metals throughout history. Now, gold's at an interesting juncture. This is a monthly chart going back to the year 2000. It's had quite a run up from $200 or $300, nearly touching 2,000, and then pulling back. And I'm going to talk about all the factors that influences gold's price and whether or not we might be on the cusp of a new breakout and bull market. Now, one of the main drivers is interest rates. And as we see here, going all the way back to the 70s, interest rates were rising quite a lot for a range of reasons. But since then, it's pretty much been all downhill until we got to that zero boundary. In other countries around the world, interest rates have actually gone negative. I'm going to talk about that towards the end as well. Now, central bank actions were meant to be short-term and accommodative since the GFC, and we see the US Federal Reserve starting to raise interest rates. But a lot of people are now thinking that, hey, they might not be able to raise interest rates too much more before we head back down again. That's got a lot of people interested in gold. Now, when we talk about gold, we often quote the US price, but in other countries around the world, a lot of fiat currencies have weakened comparatively to gold. So here's an Aussie dollar chart, again, a monthly chart of gold priced in Australian dollars. And here we see it's already broken out to new highs, getting over that $1,900 mark again recently. Now, in other countries like Venezuela that have undergone hyperinflation, their currency is basically worthless, gold's breaking out to tremendous new highs. So it all depends on the strength of your currency, but we often see that gold price, silver price quoted in US dollars. So just something to be mindful of. Now, one of the main driving factors, as I said before, is interest rates. But a lot of people don't realize the difference between interest rates and real interest rates. So the best way to describe this is if you have a savings account in a bank and you can get 5% as your interest rate, that's not much good to you if inflation is tracking at 7%. So if everything's going up at a faster pace, then your real interest rate is negative. By having money in that 5% savings account, you're actually losing value because inflation is 7%. So here we see a chart, again, going back to the 70s of real interest rates. And as we can see here, the United States in the past few years has been pretty low. Real interest rates are around 1.5%, whereas in Australia, real interest rates have been up as high as over 6%. And that's why you see gold, one of those driving reasons why gold has performed so well in Aussie dollars, as well as a range of other factors. Our economy is weakening, so much goes into it, but real interest rates is one of the big drivers of gold price. Next up, I want to talk about GDP and world growth. And we have lived throughout a tremendous time throughout history, the invention of the internet, a lot of economies booming, China absolutely taking up the world's resources and undergoing a record expansion. But people were really happy with how everything was tracking, and we just went into more and more debt. We were spending, we weren't worried about saving, we borrowed from the future. But now we see world GDP growth is slowing down. So this is a pretty clear downtrend line. It did go into the negatives during that GFC, but I think you'd all agree that this is a downward sloping line, and a lot of people borrowed thinking that everything will continue to grow and accelerate, and now we're starting to wonder whether or not that's going to be the case. Even the world's largest economies, the US and China, are now slowing down. They're not getting to that 6-7% growth that we were used to throughout history. Now, what this means is that all these people that have borrowed this debt aren't going to be able to pay it off as fast or at all if we don't have that record prosperous growth, new jobs, growing economy, all that sort of thing. If that slows down, then it gets really hard to pay down your debt, particularly if you've got interest you've got to pay on top of your debt. So if you've got a credit card or a mortgage, you've got to pay interest on that debt. And as we spoke about before, real interest rates, is your wage growing faster than the interest you've got to pay on all your debt? All that sort of thing comes into the equation. And a lot of people don't have this conversation around, hey, US national debt's nearing 22 trillion now. At what point do we say, I don't think they're going to be able to pay this back without printing even more money, risking hyperinflating their currency, losing the purchasing power of the dollar relative to other assets, and so on. Now, as we see here, since the GFC, central banks have really upped their stimulus, their accommodative policies. So we've spoken about lowering interest rates to encourage people to spend money rather than give them reward in their savings accounts, but also this printing of money to buy up assets because there wasn't a demand there from the market. So the central banks, one by one, take it in terms of printing money. So the US Fed really stepped up their game, in 2008 there, and there we see this baton pass where now it's, the ECB that are really doing the most aggressive money printing, People's Bank of China and so on. But it's one by one, these countries take it in turns of sort of printing money, and that money doesn't even have to stay in that country. If the ECB in Europe prints money, that can flow over into the US to buy stocks or assets, again, with that money that central banks have printed. Now, the theory behind this was a trickle-down wealth effect, but what we're seeing now is that even the central bankers themselves are admitting that that didn't work. It didn't make its way to the real economy. It inflated asset prices and it didn't benefit the average man on the street. They are not getting a wage growth. They're not benefiting from all that money creation. And we see it with stats like this, the number of individuals on food stamps that can't even afford food. So you hear those stories about, the lines extending around the corner back in the Great Depression for people to line up at the soup kitchens and whatnot. But here in the digital age, we don't really see that there's 45 million people that can't afford food every day in the US. So pretty crazy stats that a lot of people aren't really aware of. Now, another thing that governments have started to talk about is universal basic income. If people can't even afford to live, maybe we should give everyone a wage. Now, in different countries, we have different government programs. Everyone's got their opinion on these, but I think this is just another sign that the money system and trickle-down economics isn't really working when we're even having these conversations about, do we need to give people money just to survive? Because at the moment, the rich are getting richer and money flows up, not down. Another thing that people are talking about is this final straw. So we spoke about the central banks taking it in terms of printing money. A lot of people aren't aware of the special drawing right. Now, this has been around for a while, and it's a basket of currencies by the IMF, the International Monetary Fund. Now, if all these central banks have printed money and everyone's sort of saying, hey, that's not working, maybe they go one step further next time and the IMF come out and say, hey, we're going to pump money into the system through this special drawing right, which again, it's just a basket of currencies. This is often confusing terms for people, guys, but don't overcomplicate it. I've done some videos about this, particularly my top 10 documentaries I recommend watching to get your head around all that. I'll put a link in the description below. Another outcome here that Steve Keen talks about, Australian professor in economics, is a modern debt jubilee. People are in so much debt now and we're fearful they can't pay it back. So it's going to slow down growth forever until they're able to pay their debts down. So what if we do a modern debt jubilee where we just wipe the slate clean and say, you no longer have that debt, okay? We're going to wipe that off your balance sheet, and that way you've got to go out and spend money and spur the economy and new jobs and growth and so on. So some theories around modern debt jubilees. Again, some people strongly believe in these. Others think it would be a terrible idea, but some more reading for you if you're interested. The second reason that people are really attracted to gold is as a hedge against uncertainty. Geopolitics, an asset that can't be confiscated by your government or other countries. Now, this is an interesting one because a lot of countries have started to ask for their gold back where they've been kept in a different jurisdiction, and they're getting an answer of no. So again, having gold in your own custody, and some of the stats we're seeing are pretty crazy coming out of other countries, but I'll talk about that now. So we see these reports that China and Russia are stockpiling gold, and they want to turn away from the US as being that world reserve currency, and they really get the benefit of that, particularly with oil priced in US dollars. So Australia's got a lot of gold reserves there. We're a resource-rich country, but it's really these superpowers of China and Russia that have been stockpiling gold in their reserves. And a lot of people are starting to ask, do they know something that we don't? What are they predicting? Now, the next thing to note is central bank has been asked about keeping gold. So central banks still have their own gold reserves, and Chairman Ron Paul asked Ben Bernanke, who was the Fed Reserve Chairman at the time, why do central banks keep gold on hand? And he couldn't really answer. He's got this blank look on his face, and he sort of says, oh, it's just tradition. So since money got taken off that gold standard, it's not really backed by anything. Why are they still hoarding gold? And he's sort of saying, well, it's in case everything goes wrong. It's a bit of tradition. In some ways, to me, it's a vote of no confidence in their own system. And often what we see is when these central bankers get out of serving their term, someone like Alan Greenspan openly comes out and says that money printing QE failed and recommends buying gold. Janet Yellen came out and said, oh, I don't think there'll be another financial crisis in our lifetimes. And then the following year, she comes out and says, oh, conditions are worse. We might be heading into a crisis. So it really makes you think that these people have little to no idea what they even talk about. They say one thing, they're jawboning, mainstream media when they're in office, and then they get out and start talking about buying gold. Again, this is another concern that people have. So now we're into the industrial real world uses, and you can see here the distribution of gold by industry. So a lot of demand, the leading demand coming from jewelry, particularly in countries like India. And then we have the coins and bars, central bank purchases, and then electronics and other industrial uses. Now, a similar story for silver. It's probably got a wider range of industrial uses. It's used in a lot of solar panels and renewables, which are really growing industry, as well as electronics and others as well there. So they do have their actual industrial real-world use cases, as well as this monetary aspect and this hedge, I guess, that we've spoken about. Next thing to talk about is the gold to silver ratio. So people speculate that the abundance of these metals in the real world comes out of the ground at a ratio of somewhere around about 10. So 1 ounce of gold for every 10 ounces of silver. That's the silver to gold ratio. And when it gets to these extremes like 80, it traditionally has been the marker of when we're going to see another bull market in precious metals. We had that big bull market after the GFC when the gold to silver ratio hit 80. And here we are currently at new record highs around 85. So a lot of people saying the longer term perspective, this traditionally has been a good indicator that the metals are going to turn around. And silver outperforms gold because it's coming off that lower base, and that's why the silver to gold ratio drops to these levels. Now, the next question we get asked a lot is, how do I get exposure? And in Australia, for example, there's a range of precious metals dealers. We've got an abundance of gold and silver in this country and miners. So the first way is simply to buy bullion online. Now, we're friends with Ainsley. We're going to talk about all the ways that you can get exposure to precious metals, because the most basic way is just to buy some plain bullion. But we also have these semi-numismatic or numismatic coins, and they're collectibles, which can go up in price even more than the metal if you buy the right one. So again, it's a bit more research to do. A lot of people will just go for that most basic option of getting some gold and silver. There's storage options where you can store it at these bullion dealers if you don't have a safe at home, and that's probably the most basic way to get involved with the space. The next way is miners, and in Australia we see that Aussie dollar gold price at record highs. That means these companies are selling at record profits. So Newcrest Mining, Northern Star, Evolution, these are all companies that I invested in a number of years ago that have produced tremendous returns because of their Aussie dollar, their Australian-based nature. And there's some great ones in Australia as well as around the world, Canada, the US as well, if you want to do your research. Now, just as we talk about cryptocurrencies a lot on the channel, as you go down these smaller cap coins, it gets a lot riskier. So these are some junior miners and explorers, and these ones, again, it's that risk to reward. If they find gold, if they increase their production, then the price is going to dramatically go up rather than these companies that are out there and mining. And you hear these great stories about exploration companies striking gold and going up 10 or 100-fold in price. But guys, as always, it is all about that risk to return and uncertainty. There's so much research needs to be done if you're going to speculate in the junior or the explorer space, and I wouldn't recommend it particularly as a beginner. Next up here, we've got ETFs, and these are exchange traded funds or products on different stock markets. If you've got a stock trading account, this is a very easy way to get exposure and something that a lot of people have gone with these days. So you have ETFs that just give you exposure to the metal price or a basket of miners, junior gold miners, silver miners, all these sort of things, as well as leverage products as well. So there's an ETF for just about everything these days. But I guess a lot of people are negative on ETFs because drives the demand into these exchange traded funds rather than the real metals. And if all that money actually tried to buy gold, or particularly silver, as a relatively small market cap, it would actually push the price up a lot more, rather than these ETFs which are cash settled or rehypothecated. They don't actually have all the underlying metal behind them, and a lot of traders are able to sell more than the entire annual production of silver, for example, because they can do it with their deep pockets, their other accounts. They don't have to actually have that silver to trade it. Now, recently we've seen some mergers, and the biggest in history has just taken place between Barrick and Randgold. And traditionally, this means that we're at the early stages of a new cycle. So when the smaller companies go broke, the price of gold's gone down. There's a lot of mergers and acquisitions and takeovers as the bigger guys buy out the smaller guys. And that tends to be when we're entering a new cycle, a new boom. So something just to be aware of. This is very similar to in the cryptocurrency world, when the price of Bitcoin goes down and those that can't afford to mine it have to turn off their rigs. It's the same in the gold and silver explorer world. If the prices are low, they can't afford to explore, they're not making profits, they can't continue and they get bought out. Now, the next thing just to be aware of, there's always scammers out there, and someone that's been in this space for 10 years as myself, I remember watching videos back in 2009 and people promising with charts like this that gold was going to 6,000 and silver was going to $100 in the next few years. People have been promising that gold and silver are going to explode for a number of years. So you just have to be careful out there. A lot of people are trying to sell you something. I'm not too fussed who you buy your gold and silver or which miners you chase. I just want to give you a well-rounded educational video to let you be the judge. Now, the counter argument to this is that gold and silver have been suppressed. And if it wasn't for these traders pleading guilty to manipulating the metals markets, that maybe they would have gone to those prices because of all the money printing and the interest rate policy. So again, it's a hard one whether these people are just charlatans trying to sell you something, or if a lot of these people would have been accurate with their high price forecasts had the metals not been manipulated. And to what degree you want to say it's manipulated and why, again, I'll let you be the judge of that. Now, cryptocurrency, I've touched on this a couple of times. If you're new to the channel, this is something we speak about regularly. A lot of people have come out and said that Bitcoin and cryptocurrencies were the canary in the coal mine. The fact that there was such a huge run up in price just showed the world that there was a huge demand for an alternate to fiat currencies, and maybe that money would have gone directly into gold and silver, but instead people were so sick of the price suppression, or they didn't feel it was a true market, that instead they went into Bitcoin. Now, I think both assets are going to coexist, but the fact is that the crypto markets are still far too small for the majority of investment, and that comes from hedge funds and pension funds. And if we have a look at their asset allocation, tiny, 0.5% average asset allocation to gold and 0.01% asset allocation to silver. Now, what does that mean? If they just increase these to traditional levels, 5 or 10% of all good balanced portfolios should now have some gold and silver, the price would dramatically increase. We're talking 10 to 20-fold for gold, 100-fold for silver if people wanted that exposure to the metal. So again, I'm not sure if this is going to happen, but if there's large amounts of money, we're talking billions or trillions, that is looking for a home, if these other conditions play out, then they can't go into just Bitcoin. The market is simply too small. They will far more likely to go into Bitcoin, to gold and silver and precious metals. So wrapping it all up, if you believe that we may be on a path for a recession, an economic slowdown, if you believe there's uncertainty, if you want to hedge against inflation, if you believe there's going to be more money printing, if you believe that interest rates are going to go even lower as they always have, and some countries already have these negative interest rates. Now, if you don't want to be penalized just for having money in a savings account with negative interest rates, gold is starting to look like a very attractive option. So if you buy into that thesis, guys, if you want to do some more research, You guys know that we're friends with Paul at Ainsley. You love this interview we did with him a while back. If you've got any questions about bullion, they can help you set up your self-managed super. They have storage options. Give him a call. Paul's a great guy, and we love supporting local as well. So let me know your thoughts on gold and silver in the comments below. I'll put all the links to Ainsley Bullion in the description below. Thanks for tuning in, guys. Smash that like button. Subscribe if you haven't already. Share these videos around. And as always, thanks for tuning in, guys. Cheers.